Today, we're looking at sequencing risk. Essentially, we want to find out whether the order or sequence of investment returns makes a difference to the final result of an investment. Let's start with a simple rule of investments. As an investor, your goal when buying and selling is usually to consider the market timing, the market cycle, and ideally, when do you aim to buy and when do you aim to sell? Well, you aim to buy when prices are low and sell when prices are high and take the profit, which is the margin in between. So let's have a look at the sequence or order of investment returns given different scenarios. We have here displayed 10 years of investment returns where we have 3 negative returns in the second, third and fourth year of a sequence of 10 years. Let's look at the effect of a $100,000 lump sum being invested. Starting at the top of screen with $100,000, participating in each of the investment returns, we end up with a result of $130,421. If we reverse the sequence, so we have the same investment returns, but occurring from the bottom of the screen working upwards, we have 3 out of the last 4 investment returns being negative, we end up with exactly the same final result of $130,421. So let's see what happens when we take the same sequence but have a savings plan of $10,000 a year being added to an initial $100,000 lump sum. So if we take the original sequence where we have early negative returns, we have a result at the end of the 10th year of $260,889. Let's reverse the sequence so that the negatives occur late in the sequence of 10 years of returns, and we have a final result of $229,598. So we have a $41,000 difference in investment returns. Let's now look at the same sequence of returns, but where we have a pension or withdrawal plan occurring with initial $100,000 pension and $10,000 annual payments. Starting at the top of screen with $100,000, early negative returns mean that the portfolio is depleted in the 10th year. If we start at the bottom of screen and work our way upwards so that we have 3 of the last 4 years as negatives, we have a residual amount of $31,244 at the end of the period. This same data graphically, we can see with the blue lines, the lump sum ends up in the same result. With the green lines, the dotted line representing a late sequence of negative returns has a negative effect compared to an early sequence of negative returns. And now let's look at the red lines, with the solid line being an early sequence of negative returns, depleting the portfolio, whereas a late sequence of negative returns, leaving the portfolio with $30,000 at the end of the period. So what does this mean? Sequencing risk when it comes to lump sum investments does not exist because the order or sequence of returns makes no difference to the end result. When it comes to regular savings, the sequence of negative returns earlier in the piece is more favourable to the overall result. The reason for this is that negative returns in a savings plan forces you to buy low, which is in line with our initial theory of buy low and sell high. When it comes to regular withdrawals or pension payments, a sequence of negative returns, particularly early in the years, is more detrimental to the overall result. The reason for this is that in a pension, you are selling, and if you have a negative return in a pension, it forces you to sell low, which we all know is contrary to our investment rule. Buy low, sell high. So hopefully by going through this, we've now got an understanding of what sequencing risk is, and that sequencing risk only affects a regular withdrawal or pension plan.
This has been Eddie from Curto Consult. Thanks for watching.